Well, last year here at the Boca Raton Rural Investment Symposium, that was the first and last time we had this gentleman on, Mr. Adrian Day from Adrian Day Asset Management, and I'm welcoming him back once again. But Adrian, I gotta say, we gotta do this more than once a year.
Absolutely, and thank you, Trevor, for asking me.
It's good to see you. How have you been?
I've been fine, busy but fine.
Yes, well, there's no shortage of things to talk about. And I think it'd be best to talk about what's really been on top of my mind here today. We've had a big move higher in yields. It's been a headwind for the gold market. But what is wrong with the 5% 30-year yield? I mean, isn't that somewhat historically normal, Adrian?
Yeah, no, historically that's normal. You're absolutely right. That is obviously the big headwind for gold is we've had three things go up, in the last several months. We've had the dollar go up on safe haven on the Iran war. We've had yields go up, bond market doing the Fed's job for them. And we've also had CPI go up, and CPI going up means that there's a likelihood that we'll see higher interest rates in the future, right? Because markets always look ahead, right? If you see the CPI go up, you say, oh, wow, that's inflation. I had a gentleman say to me today, isn't that good for gold? Well, it's good for gold on the long term, but in the short term, when inflation goes up, the market looks ahead. And so we've got the situation where not only do we have as you say, yields on bonds have moved up and are now relatively attractive for people to hold. I should disclaim, I would not buy a long-term US bond right now for anything.
Yeah.
I'd want more than 5%. But anyway, but the yields are moving up to more attractive levels, and the dollar is moving up at the same time, which means they're becoming more attractive for foreign investors. So those are really headwinds for gold.
Yeah, absolutely. The market currently pricing in a 100% chance of a rate hike by year end, 48% of a second hike.
Yeah.
This is not what we were sold with Kevin Warsh here, Adrian. Any surprise there?
Well, and it's certainly not where we were at the beginning of the year, right?
Absolutely not.
I mean, the Iran war and the oil price spike has really changed everything. It's not what we were sold with Warsh. I don't know if you want to talk about Warsh.
I would love to.
Yeah, really interesting. So first of all, just to know where I'm coming from, I am not a fan of the Fed. I am not a fan of the Fed as an institution because I think essentially they are trying to do something that is impossible, not difficult, but impossible. They are price fixers, and they are trying to fix the price of the most important asset in the economy, which is money. And anytime you try to fix prices, you have problems. I'm not a fan of the Fed in terms of their history. Over the last 100 years, they have a stable dollar mandate, but the dollar has lost 99% of its purchasing power. So that is a failure any way you want to look at it. They presided over and arguably provoked the greatest economic recession in the U.S. history and the greatest inflation in U.S. history. So I'm not a fan of the Fed. I'm also not a fan of the last few people, particularly Bernanke and Yellen. They were just awful. Powell was arguably a little bit better. Greenspan was a tiny bit better, but he did know better, so he should have been a lot better. So with that background, sorry, but that's where I'm coming from. I don't want to sound naive, but I was very impressed with Warsh. So first of all, Warsh is someone who comes from the markets. He has a deep understanding of the way markets work. And that's something that Powell didn't have, and Yellen and Bernanke absolutely 100% did not. I mean, Yellen and Bernanke had spent their entire career in government or education.
Right.
Neither one had ever worked in the private sector once. And yet they're telling us what interest rates should be. So Warsh has a deep understanding of markets, and what really impressed me in that initial press conference that he had, he's clearly obviously been thinking about it, but he seems to have a clear understanding of the Fed's problems and failures. just one example, if we may. He spoke a little bit about this. The way that the Fed is looking at backward-looking data, and the way we collect that data, is inefficient and time-consuming. So by the time the Fed gets the data, and this is me talking now, not him, but by the time the Fed gets the data, think of the unemployment. The unemployment comes out in the middle of a month. So that's 6 weeks from the beginning of a month and 2 weeks from the end of a month. That's an average of 3 months, or 3 weeks. So we're already 4 weeks, sorry. We're already 4 weeks out of date. Then you have the first revision and the second revision. Those revisions are often huge. So by the time you have that final unemployment number, you're 3 months out of date. And yet the Fed is waiting for those numbers and acting on those numbers. And he made the point that corporate CEOs know what is happening in the economy in real time. They don't have to wait for government statistics to come in. He said he wants the market to react to economic data, not the market to wait for the Fed to react to old economic data.
Right.
So anyway, without going on a lot, no, I was very impressed with Warsh. We'll see what happens, because there are constraints. I mean, there's constraints, political constraints as to what he can do, and there's also economic constraints. I mean, how high can you raise interest rates when you have a fragile credit market?
Yeah. Maybe let's talk about that. And PIMCO was out a couple of weeks ago with concerns of a credit problems looming in the future. I thought that was a very poignant headline that caught my attention. I mean, especially coming from PIMCO, very credible institution.
And an institution involved in the credit market.
Absolutely.
Yeah.
And then we have all these tech names now tapping the credit market for liquidity and growth and the AI trade, and maybe we could go down that path as well. But I keep on trying, and I don't want to sound like a doom and gloomer all the time, but I keep trying to find something positive that says we've got a clear runway, but all I'm forced with is risk. I just see risk.
Yeah, well, one of the things, Adam Smith said there's an awful lot of ruin in a nation. And if you look at meaning that it can take a long time for problems to become apparent. And in the case of the United States, we've had a very strong economy, certainly since 2009, and really even before that. So the U.S. has got a strong economy, infrastructure is already built up and so on. And so when problems start to develop, it can take a long time before they become apparent. And to get to specifics on private equity, we had a bit of a scare last summer, remember, with Carvana, is that what it's called?
Carvana,
Carvana, and the other one, I forget the name now. How soon we forget.
Yes.
But we had a little bit of a scare with private credit, and then of course we've had the private BDCs in the background, private credit funds putting restrictions on redemptions, which is never a good idea, restrictions on redemptions and so on and so on. But it's really sort of been something just bubbling away in the background. But I want people to remember, 2006, was it Century? What was the mortgage company that went brown?
Century 21?
No, it wasn't Century 21. That's the brokerage firm.
Oh.
Ooh, better be careful what we say. I don't want to accuse a company of going bankrupt that didn't. It was a mortgage company. I think it was called New Century.
Okay.
And they went bankrupt spectacularly in 2006. And everybody said, that's the housing bubble burst. A month, 3 months, 6 months went by without anything else. And everybody started saying, it's over. And remember Ben Bernanke's famous thing about, there's no risk to the broader housing market. This is just subprime.
Right.
And then, of course, you had Bear Stearns and Lehman a year later. Right? These things don't have to happen immediately. That's the point I would make.
I was having a very similar thought in the back of my mind about the Kospi, and we're seeing a lot of volatility to the downside on the Korean tech trade right now. And again, consolidated into two behemoth companies, which is dangerous. But I'm just kind of wondering, it doesn't seem to really affect the U.S. tech industry that much. I mean, it's definitely not seeing 5% down on the NASDAQ the day that Cosby said 5% down.
No, that's not affecting the U.S. at all. I mean, I do think the big cap tech stocks in the U.S. are grossly overdone, and I think we're starting that rollover. I really do think so. But Korean stocks didn't seem to affect it much. Let's not forget the Korean market has collapsed, but look at the way it went up.
Yeah.
I mean, that was a classic. The chart of all these bubbles is the same. Look at 1929. Look at the Nikkei in 1980. Nikkei, 1980. Look at dot-com bubble in 2000. They all go up exponentially, and then they all, within 3-6 months, they all come back to where they started.
Yeah. Let's talk about the equity market here. I know you dabble a little bit in this sector, obviously.
Dabble.
Are you actively looking at deploying capital here? Or is there, or are we just being patient? Is there a sweet spot here that looks pretty interesting?
No, that's an excellent question, and my answer is it really depends on the investor.
Okay.
So if you're a relatively conservative investor who maybe bought gold 3 years ago and you had a 20% allocation, well, you're now at 35% allocation, even after the drop. So, unless your other stocks were in NVIDIA, your rest of your money was NVIDIA. Whatever else you were in, you've now got more than 20%. So do you need to buy more now? Absolutely not. But if you're someone, let's just say the hypothetical person has absolutely zero in gold and inherits $1 million today, absolutely, I would start putting money to work. No question. I think, you can never get the bottom, just like you can never get the top. I think there is a high possibility, not probability, but possibility of a retest of the low. And if we fail that retest, I think we could easily get down to 3,600. That would hurt the stocks dramatically. But if you have a 3 to 5 year time horizon, right, a 3 to 5 year time horizon, and you are convinced, for whatever reasons, you're convinced that gold is going to go higher over that time frame, then I absolutely would not wait to put that first dollar to work.
Yeah.
I think so we've had three things happen recently. So you've had the prices decline, so the gold stocks are down 40% from the January high, so the prices are low. More importantly, the values are low. Just look at the valuations of the big cap gold miners. They're in their lowest 25 percentile in their entire history, on every metric you care to look at. Dividend yield, price to NAV, price to cash flow, price to EBITDA. Scotiabank put out a very interesting report full of graphs and dot plots. And this year and projections for next year, in every single metric you care to look at, we're in the lowest 25 percentile of valuations ever. So low prices, low valuations, and the weakest sentiment that you could imagine. People continuing to pull money out of the GDX and GDXJ. People flooding. The money's flooding out of the gold stocks. And the bull bear sentiment index is down at about 7% bullish. 7% bullish on anything is just an absolute extreme.
It's all a contrarian dream, right?
As a contrarian, you could not imagine a better setup.
Yeah.
Might it go lower? Will it go lower? It could, absolutely. But if I had $1 million today with nothing in gold, I would definitely put 40, 50, 60% of that to work right away.
Mm-hmm. What about the risk appetite here within the mining equities? Are you thinking about deploying into riskier exploration, even real brand new greenfield exploration at all?
Well, we're investing across the board. Obviously, it depends on the client and what the client's already got. But no, I would invest across the board. I think every single area you care to look at, the big cap royalties, the big cap miners, the small royalties, the intermediates, the exploration, the new companies, they're all, broadly speaking, very, very compelling valuations. What I would say is for someone new, I would start with the bigger cap companies, the better bigger cap companies. Now, just because it's bigger doesn't mean it's more conservative or lower risk. But if you go for the better ones, the Agnico and Franco and the Wheaton, you are really reducing a risk. And the reason to go into those first is because that's where the money, the broad market, that's where they will go when they return. So when the generalist or the small institution, or indeed the retail first comes back to this sector, it'll go to those big names first. Mm-hmm. But the only thing, and this is my preference, other people are different. If you're a geologist, you have a different way of looking at companies, but I'm not a geologist. So for me, when I'm looking at the real juniors and the real explorations, I look at two things. I focus on management and everything to do with management, ethics and experience and, everything. And I look at balance sheet. Mm-hmm. Do they have capital? If they don't have capital, do they have income? If they don't have a good balance sheet or income, do they have warrants perhaps that are in the money? That's always important to look at. If you've got warrants that are in the money, that means at least they'll have some money coming in. And if they don't have any of that, the most important thing is to look at the shareholder registry. Who are the big shareholders? If Ross Beatty or Eric Sprott or Rick Rule, or indeed Adrian Day as a management, if we own big positions in a company, that company is not going to be orphaned.
Mm-hmm. Yeah.
Now, if a company's desperate and wants to raise money, Rick's going to squeeze them and get good terms. And we can say that because he says it himself. But the point is, if Ross Beatty owns 10% of a company, he will always lend them money, as long as he still likes it. If we have 10% of a company, we don't want the company to go bankrupt.
Yeah.
Right? This isn't a charitable enterprise. We're doing it out of self-interest.
Yeah. Well, Adrian, I have heard, rumors or stories of you setting terms of financings as well.
Yeah.
But I'm just kind of curious. I would love to get.
But let me just. Yes, and I'm not trying to be defensive. I'm not defensive.
Sure. No, and I actually mean that as a compliment.
But I'll give you a good example. So Lara Exploration, I think I can say this. I think I can. But it's an example. We did own 19% of Lara before they did their last financing. That is a huge amount of any company to own.
Right.
And when they told me they wanted to do a financing so they could raise money to do the exploration, I said to them, please don't do it with a warrant, and please don't do it at a discount. And they said, but we're offering you some of the stock. I said, no, I own 20% of a company. I do not want you to give a warrant, and I do not want you to do a discount. If you can raise money, in the end it was a very modest discount, but if you can raise money without a discount and without a warrant, that sends a huge signal to the market.
100%. Yeah.
And that's what they did. No warrant, very little discount, and in fact management participated. And that's the other thing I said. I'd love to see you guys actually buy the placement at this price. So yes, we definitely have conversations on pricing. Yeah. But if I already own the stock, why would I want generous, people call them generous, why would I want generous terms? Why would I want to dilute myself?
Yeah.
It doesn't make sense.
No, I totally get it, and I support that 100%. But my original question is, when did that begin to happen for you? Where it wasn't you just as like you're not just a plebe investor such as myself, but you actually got to a point where you could meaningfully take positions in financings, and then to the point where you became a 19.9% owner, and then you could start setting those terms. Like, how'd that pathway?
Yeah. Well, I think, just to be clear, the Lara was held in the Adrian Day Asset Management.
Sure.
But I think the big change, I just want to make that clear, but I think the big change came when we started managing Peter Schiff's fund, because then as a fund manager, you become a lot more, you have a bit more clout.
Yeah. That makes sense. Okay.
But people don't always listen to me. I mean, sometimes I say, do you have supportive shareholders? Can you raise the money without a discount? And, it's a bad sign if they can't. If I say I'm willing to do 20% of your placement and I'm willing to do no discount or no warrant, and then they come back to me and say, good news. It's a 15% discount and it's a 5-year warrant.
Right.
Then that means they couldn't raise the money.
Right. Well, and there's also a stronger position in there coming from a current shareholder that supports a financing under those terms, rather than going to a bank who's going to take the fees and,
of course.
and have to sell the thing, right?
Of course.
Yeah, no, absolutely. Great conversation. It's really good to see you. Have you learned anything this week?
Have I learned anything? I've learned that this is awfully busy and I don't have time to listen to the speeches.
Well, that makes two of us. All right, well, good to see you. Hopefully we can do this again here sooner and don't have to wait a whole year.
Thank you very much.
All right. The information presented should not be considered investment advice. Mining Stock Daily and its affiliates are not responsible for any loss arising from any investment decision in connection with the material presented herein. Please do your own research or speak with a licensed financial representative before making any investment decisions.